Welcome. I thought I would just do a really short video around interest rates with them rising by 0.25%. I just thought that was a really good opportunity just to discuss and just to talk about how that can affect businesses and ultimately affect lending. I'm going to try and make this super short, super fast, so try and bear with me and we'll see if we can make it go. So I've put everything into the board very quickly. It's actually two live projects we have working ourselves at the moment. We've got one that's running on a lending of 100k. We've got one that's running on the lending of 1 million. It's nice because they're simple figures, because they're nice round numbers, so it will help me run through. So what I've put together here is if we're currently looking at an interest rate of 3% on a high street lend, that means on our 100k deal, it's going to work out a £3,000 interest per annum. Obviously, we can scale this on the £1 million figure. It's going to work out at 30k per annum. That means over a 10-year term, fairly traditional term in our corporate world, that we're going to be paying back £130,000 on this 100k loan at 3% over 10 years. Ultimately, because this is what we want to know, what's our monthly payment going to be? We're going to be looking in the region of about £1,083. I say in the region, it's going to be exactly that. We can then just multiply this up onto the £1 million number. So as you're adding zeros effectively, we'd end up paying back 1.3 million over the 10-year term. We'd end up paying £10,833 per month. Okay, if we were working that on a high street lend, 3%, that's about what you're going to get at the moment. If you're looking at an investment lend, you could be looking at something about 6%. So realistically, you're just doubling your numbers. Once we talk about the top end, we're really talking about £1,333 per month payback on 160k over the 10 years. If we look at a high interest loan, where we're talking about more closer to 10%, then we could be paying back basically the 10,000 per annum, 200,000 over the 10-year term, which equates to 1,666 per month. Again, if we scale this on the £1 million figure, obviously with zeros, everything scales and compounds much faster. We'd be paying back 100k over per annum. That means we'd be paying back £2 million over a 10-year term on the £1 million loan. So it's quite a high interest rate, and we'd be paying 16,666 per year. These are live working examples that I'm literally getting quoted at the moment on these two numbers on things that we're doing and acquiring and working on lending. What's the impact? So Bank of England, thanks to their wisdom, increasing our rates by 0.25%. Doesn't sound like a lot. That 0.25% doesn't sound like a lot. And on the low end, it really isn't. But on the high end, it has a huge compounding factor. Let's have a quick look at that. So this 0.25% on our same 100k loan is going to add an additional £250 per annum. So over the course of our 10 years, that's £2,500. It doesn't seem like a lot of money, and it's not a huge amount. And when you break it back down to the monthlies, it's an extra £20.83. Now, this is the sort of thing you might see on your own mortgage, on housing mortgages and stuff like that, dealing in those kind of numbers. Let's scale it very quickly up to this £1 million figure. This same 0.25, this same 0.25% is going to be an extra £2,500 per annum. 25k on the 10-year term and an extra £208 per month. So when we think about it across the 10-year period, that 25k does become a sum that we're going to consider. And that was certainly something I looked at yesterday as the Bank of England base rate rose, or as the interest rate rose. I looked at that, I was like, wow, that's going to cost us an extra £25,000 now to lend. Now, the Bank of England will tell us that the interest rates are going to come down, and that's going to happen. We're going to get inflation down by the end of the year to about 5%, should have been 4%, now it's going to be 5%. I'm being advised something different. Now, I don't know who's right and who's wrong, but I'm being advised that there's a potential that we're actually going to get 3 more point increases over the next 18 months. And actually, we won't see interest rates coming down until 2025. As a business owner, I think it's important that we listen to obviously what the government are saying. We take stock of that. But then we also look at what's happening with our other advisors. So something that we do is we speak with financial advisors, our accountants and such. I'm being told potentially we could see 3 more point rises, which makes us another 0.75% over the next 18 months. And this is how it will affect what's going on. So if we go up another 0.75 over 3 points, that means we're going to end up paying an additional £750 per annum on our 100k loan. Over our 10-year period, that's going to add £7,500. And on a monthly basis, that's £62.50. That's on top of our existing 0.25%, and on top of what we're already paying on our existing loan percent. So you can see it starts to add up. Let's scale it really quickly up to this £1 million figure. We could end up paying an extra £7,500 per annum on our £1 million loan. That's an extra 75k over our 10-year term. Starts to get a little bit worrying there, which is another £625 on top of our 208, on top of our existing plan. So if we were up this, I've lost a pen, I should have a pen somewhere, there it is. So if we were already working here, and this was the magic numbers that we were working on, once we start adding these together, we're talking about an extra £1,000 per annum of interest, taking our 3,000 now up to what's going to be 4,000 per annum. So that's quite a jump. And suddenly we're talking about another 10k over our term. So here we're no longer on 130k, we're now talking about 140k over our 10 years. And our monthly figures, they're going to go up by about £83. So we're now going to be talking about 83, we're going to be talking about 1,165-ish pounds, give or take. So we've now jumped up. Now, it doesn't sound like a huge amount if you're a big business, but don't forget, big businesses don't borrow 100 grand. Big businesses borrow millions of pounds. So we just literally need to start adding zeros to this. So this 4k over here will become 40k. This 140,000 over here will become 1.4 mil. And then this 1165 over here will change again to our monthly figures to 11,655, give or take. So suddenly you can see the increases just compound and magnify. So what's the solution here? There's two ultimate solutions I see. I mean, I guess there's three. One is don't borrow money. The second thing is that you can look and just ride it out. So you can literally just ride, or you could say even die. You just go, ride or die, and you just go with it. The other option you have is when you take out your loans, and this is one thing that we always consider, is we can fix this rate. So we can fix our percentage certainly, but we can't control what's happening at the Bank of England. What we can do is we can fix this number right here. So when we take out our loan, we say to the bank, we're going to pay 3%, Bank of England base rate, obviously, or our lender, we're going to pay it with the Bank of England, we're going to pay then the interest rate, obviously, that's happening here. If we're on 3%, we can lock in this figure of 10,833 per month. As this rises, we won't have to pay off at this point. What we will do is we'll compound over the duration of the loan, so over the 10 years, and we will pay the addition at the end. So that means if we're going to have an increase effectively, as we're talking about here, of we go up by 1%, we're going to have this total increase of 10k per annum, which means over the course, we're going to have 100k. Rather than breaking this down and paying it monthly, I can wait until the end of my 10-year period, and I can then pay that off at the 10-year point. Now, that sounds a bit risky to some people because you're looking at that going, well, that means you're still going to pay the money back, obviously, because I'm borrowing it and I'm accumulating interest, or accruing interest, I should say. But what it does do is in the first instance, it gives me breathing space. It fixes my costs per month here, so I know what my cash flow looks like. I then have to consider what I'm doing here in 10 years' time to pay back this 100k. In theory, over 10 years, especially if you've put this in property, the property value should be growing, should be increasing. So there's the potential, actually, you've got the money back already in your asset. The other thing you can do, if you're cash savvy and you're cash rich, which isn't for every business, but it is something we look at, is rather than paying this 1%, which it total might be, over this loan on a monthly basis, we'll take the same figure, we'll take this same we'll take the same sort of 800 odd pounds per month. So let's say we take this I think it's about 833 pounds per month. And rather than put that into our loan, we could actually chuck that into a different interest account over here, which grows above, so it has to be plus the 1%. We put that in there for 10 years. When we come out of this 10-year period, we're going to have our 100k that we need for our investment, plus whatever interest we've earned above our 1%. So there's different ways of working it. That's a very crude, quick formula. It's not going to suit everybody, and there's 1,000 different ways to do this. Just thought I'd share that with you very quickly. 2 live work examples of what we're running on. At the moment, though, the biggest concern is where does this go? Does it keep climbing? or is it going to go down? Thought I'd share that with you. Bit longer than I expected, bit longer than I hoped, but that's there. Throw me your comments, thoughts, suggestions. Tell me where I got it right. Tell me where I got it wrong. And yeah, I'd love to hear from you. That's pretty much it. Off we go.